physical and emotional endurance are necessary for profitable trading. To ensure that you may approach the trading day with zeal, it is imperative to take measures. Maintaining your concentration on the deal and following your trading plan requires mental work. You do, however, have a limited supply of psychic energy. Here are a few trading psychology tips that will keep your behaviors in check and emotions stable while trading. Before continuing, if you are new to the channel, don't forget to hit the bell button and subscribe so you won't miss any of the next videos we release. Trading psychology represents various aspects of an individual's character and behaviors that influence their trading actions. Trading psychology can be as important as other attributes such as knowledge, experience, and skill in determining trading success. Trading psychology can be associated with a few specific emotions and behaviors that are often catalysts for market trading. Tips for active traders. Embrace the next mentality. Be at ease and embrace the mentality of a professional trader. If you really wish to manage risks and trade to protect your capital, go pro. Place a stop loss on your position. Who cares if you choose not to participate in the market? Simply carry out your duties and actively protect your capital. Professional traders frequently experience minor losses. Hope is a very good thing in life, but do not rely on hope. Hope is a virus that infects and destroys the world of trade. You must constantly be ready for the next transaction, whether you are doing the crushing or getting crushed. You grow egotistical if you focus only on your victories. You lose confidence and your trades weaken if you constantly think about your losses. Don't let your prior trades become burdensome. Instead, learn from them. Avoid FOMO, fear of missing out. Trading professionals find great value in knowing how to deal with FOMO. You must recognize and control FOMO as a trader as soon as it manifests. Even if it's difficult, you should keep in mind that there will always be another deal to make and that you should only trade with money you can afford to lose. When making trading decisions, FOMO can be problematic because it can impair judgment and override reasoning, in addition to having a negative emotional impact. It's common to feel as though you lost out on a great opportunity. It might be helpful to keep in mind that everyone experiences the fear, even the most seasoned traders. The most frequent FOMO-inducing situations are social media storms, inadequate risk management, impatience, unrealistic expectations, and no rules, jumping in and out of transactions. There are techniques to combat FOMO-crazy ideas, like turning off distractions like news, social media, and everything vying for your attention. Stopping mid-trade interference, accepting loss beforehand, and planning your transactions. Move on from bad days. Start small while recovering from a losing streak. Don't immediately resume trading with the same position size. Trade a modest position size on your first day back. A successful day with a modest position size can boost confidence, allowing you to expand it the following day. There are ways to bounce back from a bad trading day. Strive to see the big picture. Exercise. Leave the screens alone. Reflect on your trades from the day. Look at your past winning trades. Don't make today's trade tomorrow's problem. Inexperienced traders looking to enter the market may search for a respected educational institution to acquire the trade secrets and imitate the high returns promised by winning traders. As a beginning trader, you should keep in mind that trading is not a way to become rich quickly, and that it is a zero-sum game where someone must lose money for a deal to be profitable. This is true whether it is due to inexperience, inadequate information, or trusting snake oil merchants. So, unless you allow it, the bad transaction from today doesn't have to get worse tomorrow. The appeal of day trading is that you may always start with a clean slate when you enter the market. Focus on consistency. Consistency in trading refers to a person's continued adherence to a particular set of trading principles. This enables the trader to maintain sufficient risk management while avoiding overtrading. When it comes to the trading process, the importance of having a consistent trading plan cannot be overstated. This is because consistency produces logical trading judgments. And developing a competitive edge in the market is more dependent on a methodical approach. As said previously, developing a consistent trading strategy aids in risk management and prevents overtrading. Here are some ideas for developing a reliable trading plan. Have a trading plan. Manage your risks. Keep a trading journal. Be open-minded and flexible. Adapt to different markets. Be consistent when executing trades. Beware of blinders. Your trading thesis is merely your justification. You can better choose your entry and exit points if you have a thesis. Consider it a roadmap to help you stay on course. You can consider why you're buying this stock, how it will help you, and when you'll exit the investment when you have a thesis. If you maintain your initial premise in the face of contradictory data, you are being unreasonable and biased. You shouldn't become overly biased if you want to be a great trader. Every transaction begins with a thesis, which may be demonstrated to be true or false. Focus on what drives you. Finding out why you trade and constantly reminding yourself of these reasons is one of the best methods to use your psychological resources. Why do traders engage in a stressful activity like that? There is no one correct explanation. It varies. However, one thing is for sure. It's not for financial gain. It works for compensation. People trade the markets for a variety of reasons. There isn't a single good explanation. It is up to you. But regardless of why you trade the markets, remembering these motivational factors might help you stay motivated. On an index card, jot them down. Then attach them to one of your monitors. Keep an eye on it all day. It will be simpler to overcome challenges and eagerly persist in markets that aren't always cooperative, the more often you remind yourself of why you trade. Be skeptical of the obvious trade. As a trader, do not be easily convinced of obvious trades. Trades that look too simple or too obvious should be avoided. You should be ready to be proven wrong at all times. Overconfidence is a sign of impending tragedy. Conclusion. Many traders devote a lot of their time to developing trading methods, but these systems are only as effective as the traders who use them. By concentrating on you, the one who operates all the levers and makes all the trading decisions, then trading psychology is improved. You must also concentrate equally on the mental game and strategy if you want to succeed over the long term. That's all for today's video. Guys, tell us your views in the comments section. And if you're new to the channel, don't forget to subscribe. Thank you very much for taking the time to watch this video. See you in the next video. Cheers.